Welcome back. I'm Pierre Daly, managing editor at advisoranalyst.com, and this is Raise Your Average. My co-host is Mike Philbrick, CEO at Resolve Asset Management. Mike?
How are you, Pierre?
I'm good.
Excellent.
How about you?
Good. We got a couple of really interesting characters joining us today to give us some insights into the RMS, the risk mitigating strategy framework that they published.
Well, I'm excited. I want to talk about the contents of your white paper. For one, we've actually featured it for a couple of months, actually, as a staple item in our newsletter, our daily letter. Just because it has such a wealth of information and knowledge in there, and a way of thinking about it. Our very special guests are Jason Josephiac and Ryan Lobdell from Meketa Consulting. And what I just said is exactly what we're going to talk about today, and about how to think about and approach optimal high net worth or institutional portfolio construction using alternatives in the context of what Meketa aptly refers to as risk mitigation strategies. Jason, Ryan, welcome. It's awesome to have you guys. Thank you so much for joining us.
Yeah, thanks. It's nice to be here.
Likewise.
So earlier this year, Jason, Ryan, and their colleague, Brian Dana, co-authored a fantastic white paper titled Risk Mitigation Strategies Framework, which explores some pretty nifty new perspectives on portfolio construction, as well as exploding the misuse or overuse of jargon. You'll find the link to it in the show notes below. If you like the show while the music's playing, please hit that subscribe button, ring that bell, and please leave us a review. That helps others like you find us. Let's get started.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Jason, Ryan, welcome. It's exciting to have you on the show. We're excited to get started. Before we get started, gentlemen, please tell us about your backgrounds and how you ended up at Meketa and what you're working on these days.
Sure. I've been at Meketa in a predecessor firm for about 12 and a half years now, primarily more recently on the hedge fund side of things, and have background kind of working as more of a generalist, both on the research side and the consulting side.
And I'm Jason Josephiac. I've been at Meketa for 2 years. I've joined in May of 2021. Prior to Meketa, I spent about 7.5, 8 years at a corporate pension plan managing their portable alpha program, as well as a few other asset classes, and helped out a lot of different things. And prior to that, I was at a asset management shop, a long-only global equity shop called the Boston Company. I did that for a handful of years, more so in sales and client service, business development.
Love it.
Awesome.
So you guys kind of know what you're talking about.
I hope so.
We'll see.
Maybe, maybe you do. We'll figure it out.
All
Well,
right.
why don't we start it off with there? So when you normally see the pie chart in most what we would call maybe diversified portfolios, maybe we can start right there. What's the underlying challenge with that? Maybe, the overexposure to growth risk, the underappreciation of inflation changes. What do you see? Like, that's part of, I think, the premise of the paper is that there's a lot being missed in the underlying portion of that. Maybe we can start there.
Yeah, I think that's a great lead in to start talking about that. And that's really how we tried to launch into our description of what risk mitigating strategies are in that paper that you referenced. And the way that Jason and I and the rest of our team and our firm tries to think about it is trying to identify what risks we have in the portfolio and trying to find things, particularly if you're going to use hedge funds or something diversifying, because I know, as Jason and myself will say to anybody, hedge funds is a pretty poor term in terms of describing what we're actually doing or what actually the managers underneath the hood are doing as well. It can vary quite a bit based on what the expectations are and what they're actually trying to achieve. But back to your point about the allocation across risks, I think no matter what portfolio you look at, everybody has all of these different asset classes or strategies or line items, whatever you want to call it. They have private equity, global equity, U.S. equity, non-U.S., real estate, high yield, hedge funds, commodities, tips, investment grade bonds, whatever else you want to throw in there. And at first that seems really, really diversifying. You step back and think, well, I've got allocations to 10, 11, 12 different things. That's probably good enough. I spread across those in some weight and throw it in the optimizer and I'll probably be okay. But when we peel back the onion, at least even just one layer here and say, okay, well, what's driving the risks here? What's going to drive whether my portfolio does well or does poorly or meets my objectives or falls a little short of that? We see that most of the time, 90+% of the portfolio is driven by economic growth risk. So that shows up primarily in those equity linked securities, whether public or private.
Right.
If you're actually looking through on what the underlying risks are, particularly in the private market space, even if they're not marked as frequently as the public market stuff. And it shows up in the other things too, like high yield as well. And even in real estate, depending on how you're investing in it. So noting that as our kind of first step into thinking about what can be diversifying to a portfolio, we really want to try and think about what's diversifying to your growth risk. If that's the main key driving force of your portfolio, that's really going to drive returns over the long term. And I think, frankly, with many return targets, no matter the institution, if you're trying to hit a 7+% return, which I think many people are, they're going to have to allocate in some way, shape, or fashion to economic growth risk. So what can I have on the other side of that to balance my portfolio, to play a little defense and complement the offensive part of my portfolio?
Yeah, and you guys, you artfully opened your white paper by saying investing in hedge funds is akin to playing sports. And you refer to asset or manager selection as building or drafting an all-round athlete to your team, your portfolio. And you go on to say that championship teams tend to have both talented offense and defense. And I love that because, storytelling and analogies are really important in this business, especially when you're talking to advisors, because then you're giving them also sound bites that they can share with their own clients and convey the same thoughts. And as you said, Ryan, many strategic asset allocations have a very well-built offensive roster, which tends to move with changes in economic growth. But most portfolios, or equity risk, most portfolios have they severely lack decent defensive talent, right? So they're not likely to be championship material. So I'd love it if you guys could dig into the analogy and expand on it more, so that we can actually provide advisors and anybody listening to this, but in particular advisors, with a way of approaching this discussion in a way that's relatable, as you said in your paper.
And Pierre, the terms that we use as an industry can be difficult because it depends on who's on the other side of the table and what resonates with them and what they attach to meanings of different terms. As Ryan mentioned before, for example, hedge funds. What does that really mean?
Yeah.
Are those directional long-short equity strategies, or are those more market-neutral strategies? Are those strategies where you are explicitly long volatility, where you're buying, say, puts on the S&P 500, or are you selling puts on the S&P 500? I'm sure there's plenty of hedge fund indices out there that would categorize both of those strategies as quote-unquote hedge funds, where we want to get as far away from that as possible in terms of just bucketing everything into these labels. Because at the end of the day, it's all about the risks that you're taking. It's not about the labels. And that's why we started off that paper with that nice fancy pie chart with a bunch of different colors, bunch of different terms, description. And then when you break it down, they're highly geared toward offense, like you said. And then to get deeper into the analogy, the way that we break out risk mitigating strategies is 3 buckets, 3 pillars. It's really a tripod.
Right.
The first one is first responders. The second one, second responders. And the third leg of the tripod are diversifiers. We could also call them stabilizers. And first responders are designed to hedge against those, say, days to weeks to a few months drawdowns in general equity markets, right? Because most portfolios are highly geared toward equity risk. But there's lots of different, other ways that you can get long vol, and we can talk about that more later on. The second pillar are second responders, which are for the most part trend following strategies. Those strategies that can really pay off well during long grind down in the equity markets, such as 2022 or the GFC, where the market peaked, I believe, in the summer of 2007 and didn't find its bottom until March of 2009.
Right.
So that was a pretty long drawn out time frame with a lot of volatility in the middle and a big drop in Q4 of 2008. And the third leg of the tripod, diversifiers or stabilizers, those are more market neutral, relative value types of strategies that are meant to have more of a carry element to the portfolio so that you can pay for the, say, the negative lead in first responders or long ball. And then the types of regimes or environments where trend following might not be doing as well, such as, say, from 2013-14 through 2019. And we believe if you combine all three of those pillars, you could come up with a defensive portfolio that can zig when the rest of your strategic asset allocation is zagging, whether it's long-only public markets through equity or through credit, whether it's private markets through equity or through credit. And we use this term alternatives a lot in our industry.
Right.
But, what are alternatives? We say there's really 5 asset classes. There's FX/currency, there's interest rates, there's credit spreads, there's equities, and there's commodities. And you can be long or short those things. You can get those things in public markets and in private markets. You can have linear exposure through like beta 1 sorts of instruments like futures, or when I say beta 1, just think about the an S&P 500 ETF. Or you can have more convex payoffs, things that have accelerated gains as things go down more, and things like that would be option strategies, long option strategies, not ones that you're selling options.
Interesting. So your second responders would be diversifiers that are more structurally correlated as opposed to...
Think of those first responders as structurally negatively correlated with equity drawdown.
Right.
Second responders, we believe that they will be conditionally negatively correlated with equity drawdowns over a longer time frame. And then those diversifiers or stabilizers are designed to be uncorrelated. However, when you live in the tails, we would expect many diversifying strategies, those stabilizers, those market neutral relative value strategies, to most likely lose money during a Q1 of 2020, during Q4 of 2008, during Q4 of 2018. Now, it really depends. It really depends on what's underneath the hood, but these are just general statements as to our high-level expectations of those 3 pillars in different types of market environments, especially equity drawdowns.
But the main thing is that each of those 3 groups will behave differently to the others. Right.
Exactly.
Yeah.
Exactly.
Yeah.
Well, I think the dynamism with which they respond is probably worth digging into a little bit as well. As I think, Jason, you've highlighted a couple of examples, but the first responder, and maybe you can dig into that a little bit. I'm assuming the first responder might respond quite well in the sort of COVID realization in the early part of 2020, where you had this sort of steep decline, very quick, but also sort of pretty steep recapture. And I'm thinking that the first responders are likely to provide some value there, where your second responders would likely not provide value there in a hypothetical world. Again, just using some examples to help people sort of get their heads around that. Is that, do I have that kind of right?
I think that's fair. And I think it kind of goes back to our point about kind of recognizing the risks in the portfolio. If we want to protect against economic growth risk, we'd love to tell you this is what the next event is going to be and how it's going to occur, but we don't know. So we think it's prudent to let's diversify against a variety of different equity shock environments. So it kind of is organized in those 3 components that Jason mentioned. Starting with those first responders, we're probably expecting or trying to solve for something that's going to pay off in some shorter or more violent or higher velocity shock to equity markets, like a Q1 of 2020, like you mentioned. So in there, we're looking at things like long volatility, long duration, or just outright tail risk strategies. Obviously, there's various trade-offs across those.
So those would be the structurally uncorrelated or negatively correlated strategies.
Negatively correlated, correct. But as I think Jason mentioned too, there's even within those 3 tools there's quite a spectrum. with long treasuries,
Yeah.
which many people might use there, it's that conditional correlation, which we know didn't really hold up in 2022. It had historically. Will it happen in the future? I don't know. We don't know. It could or it could not. It just depends. And then you go to things like long volatility that are more structurally tied to what's going on in the equity markets. Typically, markets go down, at least sharply or unexpectedly. Volatility may go up, and then those profit from that. And then if you're just going to tail risk strategies, probably the most directly tied to the most well-defined or reliable payoff there. If you hit this specific insurance event, you'll get a payout. So depending on what tools in the toolkit you want to use there, it can vary on how those are set up or what might make sense for somebody. If they're really worried about, if they don't care about that Q1 of 2020 that maybe is a sharp shock and they think it's just going to bounce back and it's not going to make a big difference to their portfolio, but they're worried about those more sustained drawdowns like an 08 or a 2022, that's where the second responder bucket kicks in, those longer duration drawdowns that are months to quarters to maybe a year plus, where that conditional correlation of trend following hopefully kicks in.
So, I mean, like Q1 2020 and last year, that long treasury first responder wouldn't have worked. But the long volatility responder might have, right? Depending on what it was.
And treasuries here are really the X factor, or I should say the most difficult one to assess, because although we have it within first responders, that treasuries have done really well protecting against vicious drawdowns, say over the past 20 years. Now, will that continue in the future? We have no clue, but we just put it in the toolkit as an option for investors, given we don't, well,
maybe it applies now, right? I mean, maybe it applies today, but it definitely wasn't something. I don't think anybody would have been looking at long treasuries as a first responder diversifier in Q1 of 2020. Because rates were so low. I mean, they were, we were still in that zero interest rate environment. Why, what were, you'd be looking at that in hindsight, and even in the moment, you would have been saying, like, why would I even think of doing that?
It's that, and it also depends on how they're set up structurally with their strategic asset allocation.
Right.
If they already have a lot of rate exposure elsewhere in their fixed income book, it might not make sense for them to really have any long duration treasuries within first responders. Whereas we see most investors really don't have any exposure to these multi-asset class, multi-geography, long vol strategies. So within first responders, there's really three ways you can implement that in any combination. It's multi-asset long volatility, it's tail risk hedging, and it's those long duration treasuries. Now, again, it depends on the facts and circumstances and the objectives of an investor of what tools they want to use as part of that toolkit, and where else they might have exposure to some of those things across their asset allocation.
The other thing is the one might think that the opportunity for capital appreciation via bonds is next to nothing when rates are at 1 or 2%. But we saw the German bond go from 1.5% positive to 1% negative and produce substantial returns for German portfolios or European portfolios, Euro portfolios, if you will. So it's a really interesting situation where you're also trying to manage the regime potential shifts in the sort of the underlying risk factors. So as by way of sort of comparison, the 60-40 portfolio typically contains 60% stocks and 40% bonds, but presents a situation where you have 90% risk of the portfolio in stocks, i.e. 90% plus of the portfolio's risk targeted at economic growth and not much targeted elsewhere, which is where you generally start in the paper as well. There's this overwhelming bias towards these sort of factors that are growth oriented. In this sort of risk mitigating strategies, do you guys, or do you work with clients to postulate, well, are you worried about inflation risk? Is that something that is on your mind? How would assets perform in that? And would you develop a set of strategies that would help sort of address those types of issues for those clients? Is that sort of the bespoke side of maybe the consultative approach? Or maybe is overstepping the paper, but just thinking about the actual sources of risk? How do you guys contemplate that in the RMS framework? Maybe that's a better question.
There you go.
Yeah, well, I think the first answer is it depends, right? What, to your point, what are you trying to solve for? What are you worried about?
Yeah.
But how we frame it in the paper is relative to equity markets, since I think that's the biggest risk. But you could think about it the same way. If what you're worried about is inflation, you may use the same tools and building blocks, but it may change the allocation across the three components, or what you're using underneath the hood. Trend following has historically been pretty good diversifier in times of high inflation. Maybe you consider allocating more to a second responders bucket, or other strategies that are more closely or have been historically performed well in that type of environment.
Yeah, in general, like when stuff is happening in the world and vol is higher, this is when these strategies across the spectrum really can be additive to the bottom line. And while we all might love to take our crystal ball and talk about inflation or deflation or high growth or low growth, the answer is it's just that we don't know, and we're trying to build portfolios to prepare for all different types of environments. However, let's go back to treasuries for a moment. If you go back to 1926 and take rolling 5-year correlations of equities versus bonds, and then look at the rolling 5-year annualized return or the annualized inflation rate, whenever that 5-year annualized inflation rate is over 3%, 90% of the time, the correlation between equities and bonds has been positive.
Right.
Now, from the year about 2000 up until 2021 or so, that correlation between equities and bonds was negative. And most of us have lived our careers over the past 20 or 25 years. So we've been trained by the fiscal authorities, by the monetary authorities, that when stuff happens, we can just do things with rates, do things with QE, and these other programs that kind of hide the risks that want to come out, but they don't come out because of all these other tools that are in the toolkit with what I just described. And we don't know if that's changing. It feels like it's changing.
Yeah.
But I probably would have said back in 2012, 2013, when you had the first few rounds of QE starting, that, oh yeah, this is not going to end well. And then 10 years later, we're at all-time highs. Markets have grinded higher, and you just can't be flipping around your strategic asset allocation based on some sort of assessment of inflation or growth, because things happen too quickly. The tail risks happen fast. The tail risks to the upside and to the downside. So you need to have that home base, that strategic asset allocation that can be a ballast to these different outcomes. And from what we see in the marketplace is most investors, getting back to the whole football or sports analogy, most investors are still highly geared toward an offensive-minded portfolio.
Right.
And so when you think of these, the first responders and sort of the more explicit hedges, are you thinking of them, truly thinking of them as insurance, i.e. there's a cost to owning them generally, or not really? I mean, the perfect one is when you positive carry and you have this tail hedge, but how do you work through the machinations of maybe you have both? I don't know. How do you think through those first sort of first responders, tail risk, explicit hedge type of considerations where you're looking for that payoff, and you are considering it a bit of a insurance type scenario? And to be fair, there should be some thought given to if there is an insurance premium being paid. That's not a terrible thing, especially if you get a huge injection of capital into the portfolio at an opportune time, right? So in a hypothetical world, you have something that goes wrong very quickly, and this first responder provides the portfolio wonderful injection of profit where that can be spread across other assets that may be providing long-term carry and at a great price. But how do you guys think through that? Is it truly a cost of insurance? Is it a bit of both? How do you think through that?
Yeah. So treasuries aside, because treasuries should carry, positive, right, over the long term. So let's put treasuries aside. When it comes to multi-asset, long ball, we would expect that to bleed over the longer term. Now, folks miss with first responders and long ball is that they look at these strategies in isolation. They don't look at it as part of the complete team, where For example, with football on defense can score points too. You can get a pick six, run back for a touchdown. You can get a fumble recovery, run back for a touchdown. You get a safety. Now, do those things happen all that often throughout the course of a game or throughout the course of the season? No, not as much as your offense scores. However, it does happen. But more importantly, your defense is there to put your offense in a better position to score over time. And that's what those long volatility strategies are really meant for, to put your long-only equities, your private investments in a better position to enter those trades when it feels the worst to do that. Because if you don't have this exposure, you don't have anything that's zigging when those things are zagging. Hence, you cannot just structurally rebalance into cheaper prices.
Yeah.
And I would say roughly, just in general, maybe a third to a half of the benefit from long vol comes from the outright return from the strategy, and the other 2/3 to 1/2 comes from being able to rebalance into things like long-only equities, long-only credit, maybe treasuries, maybe private investments, fund those capital calls for your private equity or for other things in your portfolio.
Yeah, and that's underestimated, right? The rebalancing premium.
Yeah, I think that's pretty key to this whole thing is if we're going to allocate to something that's going to be different than equities, how and when am I going to be able to get my capital out to rebalance? I don't want to just invest in something that like long vol that's, if it's a negative, let's just call it zero expected return, and it looks very different than the rest of my portfolio. But by the time I get my capital back, equities have already rallied and it doesn't matter. And maybe I had to pay out for whatever purpose, some distributions out of the portfolio, and I had to sell my equities when they were down. It's really nice to have something that's up to sell and be liquid enough to fund those capital constraints, or just to rebalance into your equities, or to fund capital calls, or whatever it may be.
Yeah, it drives against generally the individual's bias to not want to sell the thing that's up, and definitely not want to buy the thing that's down. And this is where you have that professional level of management where it goes on under the hood, hopefully, where these things and decisions are being made, maybe probably rules-based, and are a function of you have a win. And that can be sometimes a bit of the challenge with the first responders, I would imagine, is that you do have to, cut the tail off or monetize that, put it to the other portfolios, or then you have the tail wagging the dog. You have the first responders in the portfolio wagging the entire dog portfolio, which is also something else that needs to be, you need to be mindful of. So,
well, yeah, I mean, and for the last decade, or even a little longer, nobody, as long as equities were going up and to the left, up and to the right. I'm thinking of the efficient frontier at the same time, but up and to the right. Nobody wanted to carry those in their portfolio.
Yep.
As long as money was free or nearly free with QE, but that's all changed, right? I mean, now money's no longer free. Now, short-term paper carries, provides 5%, long bonds, 3 something, and you don't have that luxury anymore. And then, we could be up against some, who knows what, economic shocks or market events in the coming years. And, all of a sudden, the diversifiers have become a topic of interest. And I mean, it makes sense that it wasn't a topic of interest for a very long time. But there's kind of a renaissance, right?
Up here, we would, I think, take the other side of there was reasons for this not to be a topic of interest, because if you take this back in time,
well, with advisors anyway, I mean,
I understand.
That line item risk, is always a big issue with advisors. Maybe not with institutional investors, but definitely with advisors.
It's both.
It's both.
Yeah. Because
make no mistake.
Jason, go ahead.
Well, even if you take this stuff through the past, say, 15 years, we would say your portfolio would have been much better off over the past 15 years having this stuff in it than not having it in it. even with this massive, beta run in equities and the proliferation of private markets across a lot of portfolios, the pure diversification effect of doing this enabled you to take more risk in those things when it made sense to take more risk, and it helped to blunt the tail risk and the left part of the distribution to then raise the probability of having a higher compounded return over time. And we get that feedback a lot where, why do I want this in my portfolio when markets have been so good over the past 15, 20 years? And the simple answer is because the markets have been so good to you over the past 15 or 20 years. But even if you have that mindset, and again, if you take it back and you go through the modeling, and you go through all the different scenarios, portfolios, for the most part, again, there's a lot of nuance here in how you implement this, but we believe that we could raise the probability of meeting a required minimum return. We're not trying to shoot the lights out here, right? We're trying to smooth out the path along the way. This is not a portfolio that we're saying, okay, in a tail event, you're going to have a multi-bagger payout. It's not like that. We are trying to raise the probability of having a smoother return over any given point in time, as well as throughout different look-back periods.
So before we jump into second responder, Sue, and I think this is a really good point to emphasize right here while you're on it, Jason, the idea of what's the pool of assets for? It's often to fund obligations, right? Those obligations are from allocators, from wealthy individuals. They have some sort of allocation or some sort of decumulation in the portfolio. And the volatility of the portfolio is actually very informative of how much you can sustainably withdraw from a portfolio. And so if you can even have a slightly lower return and have a lower volatility in the portfolio, the sustainable payout ratio of the portfolio is higher. And I think that's something that is underestimated, underappreciated, and lost on a lot of folks who are skewing to more and more of that economic growth sensitivity in their portfolios. I don't know if you agree with that or you want to add to that, as to the whole process is, I think, to kind of push people in that direction or educate them to move in that direction.
And let's use a real world example where during the pandemic, say you needed to build out some sort of office space in order to, be more comfortable, in your job. And again, we have first world problems here. So I want to be cognizant of all the people that, don't have the luxury, or I'm not sure if it's always a luxury of, working from home. If you didn't have something in your personal portfolio to offset the risk in Q1 of 2020, then perhaps you didn't have the capital to really put into an investment like that to build out, a home office space. So again, that's kind of trying to bring it back to the, advisor level, the individual level, where you want something that can zig where everything else is zagging, because perhaps you have some sort of liability that comes to you at some point in time that's really chunky. And if you live in this world where everything is sort of based on the average return or average risk, you can really get punched in the face during those worst of times.
Well, this is the entrepreneurial risk, right? I mean, if you think about wealthy investors, most of whom got that way through, their businesses, whether it's small or large businesses, they're more interested in staying wealthy than getting significantly wealthier. If it happens, wonderful, but it's much more important to that sort of cohort of investors to keep their wealth and also to diversify some of it away from that sort of standard, that economic risk that we're talking about, for exactly what you just, detailed, Jason, which is that your business might need capital from its assets at the exact moment when the markets are down. So if you didn't diversify your business, your corporate or your endowment or your, whatever the assets that are held in your company are invested, if you didn't diversify them properly, then you might find yourself in a double whammy where not only do you need capital, but your sources of capital have been through a drawdown. And so you'd want to avoid that. So entrepreneurs, the entrepreneurial class, wealthy class of entrepreneurs are not interested in the next home run. They're interested in just getting on base and staying there, and then walking in or running in the runs, as opposed to always trying to hit home runs.
And one more thing I'd say on the first responder long ball topic before we move on to second responders is that getting back to that multi-asset class approach, you also want to be multi-manager, because in 2020, I think in general, a lot of long volatility strategies, we would have been fairly happy. But in 2022, with the markets down, the 60-40 portfolio down 15, 16, 17%, depending on how you measure it, equity only vol didn't do that well. Now that depends on how you implement it. But if you're implementing, say, with deep out of money, 3-month or 6-month sort of rolling puts, that strategy got cut up. However, if you were multi-asset class and you had long vol in areas like FX currencies and interest rates and commodities, then you had a pretty decent year. Now, again, we don't know what asset class is going to perform, but that's why it's crucial to have vol exposure. And this is a theme throughout all of RMS and the 3 pillars here. You want exposure across all asset classes, across different tenors, across different strike prices, so you really raise that probability of performing regardless of whatever the event might be.
Nice. Yeah. So let's move into the second responders.
Yeah.
And here you've really kind of looked at the commodity trading advisor space and the trend followers, and maybe you can walk us through what the logic is there.
Yeah, sure. So, I mean, kind of as implied by the name, they're meant to be second responders. So those kind of longer, more drawn out drawdowns. So something like a tech bubble, 08, 2022. So the natural place to look was trend following, and these managers or strategies that are going long and short interest rates, currencies, commodities, equities, based on what the trends in those markets are. Typically, just on average, medium term. So something that lines up with that kind of 6 to 9 month drawdown, where those models are looking back and saying, hey, our market's going up or down over those periods, purely systematic. Let's go long if they're going up, go short if they're going down. And historically, that's been a pretty good strategy to have in those periods, producing pretty significant gains, but oftentimes not from the places that you might think. So I think naturally, we hear that and we think, oh, well, the main drivers of that, because equities are going down, must have been short equities. But typically it's not that, because they're diversified, similar to those multi-asset class long vol managers or strategies that Jason mentioned. These are doing the same thing. So when equities are going down in 08, when being long duration, long treasuries worked really well, they were going long those assets. They were also able to be pretty dynamic, and some of the gains in 2022 that we saw were from going short those same securities as long duration U.S. treasuries were falling as well.
And it's amazing too. And you guys in the paper itself, you've got the SG trend index against global equity.
Mm-hmm.
And I think a complementary piece, if people are listening to this and they want to sort of get their heads wrapped around the differentiation or the difference in the performance of these types of strategies, defying the bear's grasp, the emotional journey of managed futures prosperity that we wrote, I think is what would help. But if you're looking at the paper and, you guys have got in the second responders, you can see that SG trend index actually since 1999 outperforms global equity. That doesn't always outperform, but it's outperformed it pretty substantially. Now that's the big long 22-year equity line. Now within that 22-year equity line, and if you own those trend following types of strategies from 2014, 15 to 2020, what you felt was a persistent and pervasive underperformance in your portfolio. But again, the future always holds what the past is yet to reveal. And I think this is what, Jason, you and Ryan are getting at, is you want to build a portfolio that's got 4-wheel drive, that's going to get you to work, whether it's snowing, sunny, or raining. You're still going to get to work. Driving a sports car, you're going to have more difficulties in the variance of the weather, the variance of the weathering markets. So this is not, it sounds really good and it sounds really easy. It's definitely hard. And that behavioral barrier is what makes it pay off in the long run. It's what attenuates the volatility, increases the consistency of the performance. But so trend, they're going to be long or short, these various different asset classes. They're going to respond a little bit later. What's your sense with the cost of carry there? I'm assuming that cost is not sort of as large as you might expect in the first responders. Maybe you can comment to that a little bit.
It's a beautiful chart, by the way.
Yeah, I think you make a good point though. If you were to just shorten that chart and you cut it at the end of that commodity rally in 2014, it was a really tough time to hold trend following strategies from then all the way to 2020. And a lot of talk about, is trend following dead? Is it still useful in a portfolio? But those people that held it and was in there, they recognized the reason that it was in there and it played a specific role, were able to benefit from that pretty significantly over the last 2-ish years. But getting back to your...
That's the danger, right? The danger is that you get into it at the time when it's most popular.
Right.
Right.
I mean,
and you get out of it at the time when it's least popular. So, you know, you're just falling, you know, as a diversifier, as an investor who's diversifying or trying to make a diversifying decision, you're also, even if you know, I mean, if you look at it contextually in the context of a portfolio as opposed to in isolation, I mean, that's the problem, right? A lot of investors looked at trend following in isolation and said, oh, this is doing really well, I'm going to do this. And then it turned out to be the worst thing for their portfolio at the best time, the worst thing at the best time. And so how do you overcome, you know, the timing issues? Even, you know, diversification has timing problems too, right? It's not just you know, the core 60-40 portfolio we're talking about, but adding diversifiers also has a timing problem.
Yeah,
potentially.
I think the most common question we get, particularly recently, is, did I miss it? Is it too late?
Yeah.
Is it worth it for me to do this anymore? And we always go back to that point of, you don't know what's going to happen. The point of allocating to these or considering these is we're considering not just trend following, but we're also thinking about first responders and diversifiers, so that as a group, we have something that hopefully gives you positive expected return, regardless of the market environment, or at least over the long term. You have different things in there that's going to pay off in different times, and bad markets, good markets, sideways markets. And it's going to provide you some convexity or some upside in those both very poor markets and maybe in the up markets as well. Sometimes when we talk about it, I like to talk about it as these different levers that you have to pull within your portfolio. And you want to be able to pull different levers at different times. So when Q1 of 2020 happened, I don't need to pull all three at the same time, but I can pull that first responders lever. I can take that capital off the table and rebalance it back in equities or use it for something else. Another environment comes, an inflationary shock 2022. Really glad I had that second responders lever. Let's pull that and rebalance that off the table. That could happen again in the next 12 months. You could see another rally in trend following, or you could not. It just depends on where markets are going. And that's kind of the beauty of the systematic fashion that those are implemented. It's purely price driven. It's not somebody sitting there having a discretionary opinion on, well, I think the fundamentals of markets are going to go up or go down, and peeling that back a layer further and thinking about allocating across those three legs of the stool in the similar kind of strategic fashion where we always hold in our portfolio. We have a policy or a procedure that we always point back to and say, okay, let's rebalance when things get out of whack. Let's add capital when trend following is down, not just neglect it and let it go away, because we want it to be there. We want that lever to be as useful as possible when we need it. And I think that is really important. And combining the three together in complementary pieces hopefully allows you to hold the whole thing through the long term. It allows you to hold trend following in that 2015 to 2020 period when it was really struggling, because you have those diversifiers, whether it's global macro or something else that's bringing more positive carry to the portfolio. Well, trend is, I think, we would argue, gives you a positive return over the long term. Shouldn't be a drag on your portfolio at all. It's very different than what's happening in long vol or tail risk strategies, but it does go through periods of falling out of favor. And it's really nice to have other things around it to let you hold that until it really pays off.
Yeah. And that's what I wanted to make sure you highlighted, is that it's not expected that you have that sort of maybe zero or slightly even slight bleed in the portfolio for trend following. Trend following is going to, it's expected that it's going to create a positive return vector on a regular basis. And maybe Brian or Jason, just jump into the nice complement it makes to that equity portfolio, that economic growth portfolio that we're so sensitive to. I know you mentioned it in the paper, but it can be short equities. And how does that convex payoff and that payout sort of complement, that growth portfolio?
Can I just add
Or
something?
did I steal that thunder already?
I just wanted to add that it makes sense to have a you don't just suddenly like go out and buy a bundle of first and second responders all at once. I mean, there's a period of adjustment. There's tactical moments where you want to add to some of these strategies, depending on where they are in price and valuation, or timing wise. But as far as not knowing the timing, you want to kind of average out of your core portfolio holdings and into some of these diversifiers over this period of adjustment, whatever that is. It could be 2 years, could be 3 years, but that way you're not subjecting your portfolio to a timing shock or potential timing shock.
Yeah, I think that's a tough one to answer. I think there's, for a long time, there's been research on both sides of the coin on that one, whether you should just average into it. I think some stuff more recently says just go to the right to the optimal portfolio. It might be beyond the scope of risk mitigating strategies. And that
goes to what you were saying, Ryan, right? Which is that if you're buying this whole group of first and second responders, then they should all offset each other all at once.
Yeah, I think right?
in a manner,
they all should be complementary, right? And I think you do highlight a really important point on a governance piece of this. So if you're thinking about, if you're going to have a track record that you're reporting in a performance report, and you're going to say, I'm going to allocate to risk mitigating strategies. Let's just start with long duration treasuries at the beginning of 2022, and I'll add the other stuff later. And then you add that other stuff later, but the first year of the track record in your performance report, whatever you're reporting to your constituents or your fund or whoever it may be, is really skewed towards just that one long treasury. So I think it's important to think about the governance and the reporting structure of it as you implement. And even before that, really emphasize the education piece of it. And I think that's really important to really understand this is going to zig when your other stuff's zagging, and that's okay.
Well, do you want to have a massive bet on economic growth? That's the question to ask yourself. If you're sitting there saying, well, I don't want to do it today, I missed it today, or I do not want to diversify today, what you're saying is, no, I would like to continue on with a massive bet on economic growth while the central banks of the world are contracting liquidity and growth is falling off a cliff. Sure, go for it. Maybe that's not the environment we're in. Maybe it is. But what you're saying is it's not, because I don't want to do it today.
Yeah.
So I think the overarching theme is, do you want to take a step in the right direction? Or are you going to stay on the path that maybe you're going to get lucky in, or maybe you're not? And I just want to come back to the trend follower, because I don't think the question got around, but I just want to,
back
in
to
the paper, they cover that you guys cover why trend following is a nice complement to this economically growth sensitive portfolio. And that simply is, it will be short equities at times, and it will give you a payoff and help hedge some of the things that are in your predominantly growth portfolio, if we assume that's the case. That's not the case for everybody, but those with that. There's a particular type of extra layer of maybe risk mitigation or convexity to the portfolio that trend following brings. And that's what I was trying to get you to dig into a little bit more. And I don't know if I've bastardized it or covered it well enough. So you guys, having written it and probably thought about it some more and been knee deep in the data, what else am I missing there?
Well, I think that just how risk is being taken is an important thing. And thinking about how these strategies are somewhat dynamic. So it doesn't really matter what direction markets are going. It only matters that they're trending in a direction, right? And you can profit off of equities, currencies, commodities, fixed income, I think to your point on being short equities, when most people think about it, that's the thing that they think about. Oh, well, this is going to benefit my portfolio because it is going to be short equities. And that's what's going to be the driver of returns in an '08, in a 2022. But it's actually, while it may be beneficial at the margin, I think typically at least historically has not been the case in the more recent larger shocks. It's benefited from being long treasuries or short treasuries in 2022, being long the dollar, or being long commodities in an inflationary shock really paid dividends. So it's as you might think of it as if an event occurs in one market, let's just say it occurs in equities, it often spills over into other markets, and trend followers may be able to pick up those trends as they develop and as the market begins to react or start to digest that data in other markets.
And it cuts through the noise of all the different narratives that are out in the marketplace where, we're not going to need oil anymore because of renewables. Like, well, trend is going to ignore that narrative and get long oil when it makes sense, or nat gas, or whatever it might be. Now, perhaps longer term, that narrative may make sense, and you might want to pick and choose your spot in the private markets when it comes to those renewable resources or nuclear, whatever that might be. But however, that's not the reality of the situation the market is in today based on price. So what is the price telling you, right? Are those things breaking out breaking out into, higher trends, or, trends on the upside, trends on the downside? Ignore the Bloomberg headlines. We have other managers that look at that stuff. It's really just diversifying your approaches as well in terms of the different types of strategies that you implement underneath the hood. And there's a lot of investors that probably don't have enough exposure to commodities and trend following, depending on what types of strategies that you're invested in and how they think about the world. And are they heavy in the financials or more heavily invested in the commodity space? Right there is bang for your buck in terms of diversification by having that exposure to commodities across many different markets.
Love it. What,
Excellent.
you want to jump into the diversifiers now? This is probably Tell me about the diversifiers.
Yeah.
The global macro, I mean, this is kind of, to me, one of the harder parts. I don't know. I don't know how you guys.
There's a lot of dispersion here.
Little bit more nebulous, if you will.
Yeah.
So how do you guys think through the diversifiers and trying to parse, what is alpha versus ARP or the, alternative risk premium, those types of things? How do you work through that?
Yeah. High level, think about diversifiers as a suite of strategies that can synthetically replicate bonds with a higher carry and a less crummy negative skew profile. So what do I mean by that? Credit, when tail events happen, credit tends to get hit pretty hard. At the same time, that's because we tend to be going through a deleveraging event, right? Mm-hmm. At the same time, for diversifiers, things that are designed to be market neutral, relative value, beta neutral, they tend to use a decent amount of leverage in order to put up a respectable return. However, when we run the math and run different scenarios, we see that diversifiers / market neutral tends to have a better downside risk profile relative to fixed income. When I say fixed income, I mean, elements of credit, not just, pure treasury risk. And so if you can have something that can have a higher absolute return relative to the coupon that you get from, say, investment grade corporate bonds, and that protects better on the downside, then we view that as, again, I wouldn't say a replacement for bonds, but a nice complement for bonds that can live within this risk mitigating strategies framework. And that can act as that ballast, as that positive carry, that coupon that can help pay for the exposure, especially within long vol first responders. And then during those time frames where things like trend may not be doing that well because of the environment that we're in, such as we mentioned before, from that 14-15 period through to 2019.
Interesting. And you said earlier that the diversifiers, because they are expected to basically provide a total return from their strategies, that you could use that for example, for covering fees on or carry. And that would be like fee budgeting, right?
It's that's part of it, and the other part is how can you diversify that, say, Barclays Ag, or what's the index now, Bloomberg Ag exposure, and think about how in different types of environments or regime changes or phase shifts, what strategies can complement bonds. And we believe there's lots of different strategies that are relative value, market neutral, beta neutral, that if you put together a suite of those, it can achieve those goals.
Interesting. So they're meant to be viewed as synthetic bonds, basically, or synthetic.
That's one way to describe it.
Yeah.
It's not, we're not investing in these things for contractual income, right? It gets back to more of that profile of a stable return. And I hate using the term absolute return, because in a Q1 of 2020, like this portfolio of diversifiers, market neutral, most likely will get hit, right? There are no free lunches. Just like in long vol,
Right.
You can't expect long vol to carry positive. You're going to bleed. If you're not bleeding, then you have hidden risks where someone is selling volatility. And then when that storm comes in Q1 of 2020, they're going to get blown out. And if you have a long vol manager that's trying to pay for the negative carry in a way that is not highly risk managed, and we would probably say, don't even try for the most part to pay for that negative carry, then you can just get taken out on a stretcher, and before you know it, your first responders are highly correlated to those equity drawdowns. Your diversifiers are getting blown out because there's elements of leverage to help put up a respectable absolute return. And then trend really is a toss up depending on what the environment looks like across various different asset classes.
So when you're thinking about putting this framework to work, and I know you cover a bit of this in the paper too, you're thinking through the initial conditions too, right? You're thinking through, is this a multi-asset portfolio? Is this a heavy growth tilted portfolio? Is this an LDI type portfolio? In thinking about how you would structure the RMS around those things, am I correct in sort of heading in that direction?
There's
maybe you want to fill in the gaps for us there or expand upon it, if you will.
Yeah, I mean, we do view it as a tripod. However, if an entity has a lot of exposure to, say, private investments, or most of their portfolio is equity risk, then maybe you want more in first and second responders in order to perform better in those tail events, right? So it depends on the initial starting conditions of the asset allocation and whether an investor is already fairly balanced across different sort of economic regimes and asset classes, or are they mostly playing offense as we described before? However, now when we see investors think about implementing these things, if you're focused on one leg of the tripod, we call it tripod for a reason, because if you kick out one leg of the tripod, the whole thing falls down. So At the end of the day, we ultimately believe you need risk in each one of the three buckets. And just getting back to the analogy of defense, we're not putting a bunch of linebackers on the field, right? We're not putting a bunch of only safeties on the field. We're not only putting linemen on the field. We're putting all the functional positions on the defensive team to help raise the probability of performing during different types of sell-offs.
Yeah. So
but if you look at the team you're adding the thing to, though, and it's a whole team of linebackers, you probably would have to, like, as you say, if it was all growth risk, all you got is linebackers on the field, and you come in, you go, well, I think we need some first and second responders here, because we need the defensive line and we need the defensive backs to complement this bias already in the construction of whomever's underlying portfolio is built. I guess that's, I agree that, it's always best to have a, what is it, a 5-tool baseball player? Like it's that, the best, but if you got, you still have to think about the gestalt of it all too, I suppose.
Well, getting back to that hedge fund conversation, right? There's a lot of investors might have a hedge fund bucket or an alts bucket or an absolute return bucket. Now, when you look underneath the hood, if it's a bunch of directional long short equity, then we say, hey, you don't even have linemen on the field. You still have elements of the offensive team on the field. But if they already have, a more market neutral sort of exposure within their hedge fund allocation, then maybe they don't need more market neutral. Maybe they just need trend and long vol exposure there.
Excellent. I mean, yeah.
All right.
So the idea is that each of the three sort of silos, the first responders, second responders, and diversifiers, each have their, independent of one another. They each have their own volatility. They have their own internal. They have their own market pressures happening within each silo or each leg of that tripod, pushing up against, holding up the portfolio.
Yeah, and the reason why we package it up into those, the tripod, is that in general we see that investors are woefully underallocated to all three legs of the tripod, right? It's not like there's a lot of investors out there that already have a lot of even market neutral exposure, or never mind trend or long ball. So if you can wrap it up in a way that is palpable for investors to hold it behaviorally, then I think we can raise the probability of success over the longer time frame or at any given point in time.
Mm-hmm.
What are the major objections that we've missed in chatting with you today? Have we missed anything that where we haven't asked you the question, or that you sort of get repeated back at you as you walk, potential folks through the framework and that sort of thing?
Well, I think, the first one that I mentioned earlier was, did we miss it? Is it still worth doing this? I think another one we hear, Jason and I hear pretty often, is, if we're going to do this, why do we need the diversifiers? If they're not actually risk mitigating, like, what are they useful for? And I think Jason kind of just already answered that. It's about the collection of the whole rather than having only one. It's if you only had defensive line and a secondary, you got a big gap in the middle. Your defense might
some
fall
of the
apart.
parts.
Yeah, right.
Yeah.
So you got to think about it holistically.
In 2020, folks would have loved first responders / long vol. In 2021, folks would have loved diversifiers. In 2022, folks would have loved trend following second responders. So, going back in time,
you don't get there by market timing. You get there strategically, right?
Right.
It's not tactical. It's purely strategic. It's something you have to already have been doing.
Mm-hmm.
Right. You got to have the protection in place before the event occurs. You can't go out and buy it after go buy insurance after your house burns down or you get in a car accident. You got to have it beforehand, and you got to be able to hold it until you get there. So if you just had trend in that 15 to 20 period, there might have been a lot of questions going around on the board or across investment professionals or with advisors, whoever it may be. Do we still want to have this? Well, let's keep it. Let's reduce the weight down. Let's cut it in half or something. And then when that happens, either you don't have it or you don't have it nearly as much of it as you thought you wanted.
Precisely.
And the other thing I would say is this whole, notion of hedge funds and investors. Like, hedge funds have been a 4-letter word for folks for a long time. And I think for a good reason, because some of the strategies that have garnered a lot of assets are those more directional strategies that have played the macro quite well. Maybe not in the macro well, just their strategy tends to be do well in the conditions that we've had. And when you're collecting a 20% incentive fee on, say, a 0.5 or 0.6 embedded beta, equity beta, that's not necessarily a fair share or a fair handshake for investors, because you can get equity beta for next to nothing.
Right.
Now, that's not us saying that those strategies can't be additive to the strategic asset allocation. We believe they can be. But when they're sold as quote unquote hedge funds, and you go through the tail events, you go through the Q1s of 2020, you go through the GFCs, you go through 2022, and then these things are down 10, 20, 30, 40, 50%. Like, how can you say that that's hedging? It is absolutely not hedging. Hence the reason we try to stay away from the term alternatives. We should try to stay away from the term hedge fund, because it just means way too many different things to way too many different constituents.
Yeah, that makes sense. It's far too broad of a term. Jason, Ryan, where can people find you?
So I think the natural place to find us would just be at our website, Meketa.com. If you're looking for the white paper or any other research content we put out, you can navigate to the thought leadership portion of that page. And hopefully we're pretty easy to find there with our contact info, and that should be, I think that's the only place or the best place to point people.
Great.
All right. Gentlemen, thank you so much. I think the conversation could easily have continued, but I got to respect Mike's schedule. He's got a plane to catch.
Yeah.
We'll do another hour later.
So, absolutely. Anytime, guys. That was a fascinating conversation. I think there's so much food for thought in what we just talked about, and takeaways. You guys have a really eloquent way of describing the need for more diversification for risk management.
Well, thank you, and thanks for having us on. We really appreciate it. It's nice to talk to you both.
Thanks, guys. Great seeing you again.